Ways for investors to participate in an IPO-1 for retail investors in Hong Kong. There are generally three main ways to participate in an initial public offering IPO. Each method comes with its own set of characteristics, risks, and potential rewards, catering to different investment preferences and risk tolerances. Understanding these approaches in detail is crucial for making informed decisions that align with one's financial goals. Public subscription, the most common method. Public subscription stands as the primary avenue through which retail investors in Hong Kong get involved in IPOs. It offers a straightforward way to apply for shares directly from the issuing company before they start trading on the stock exchange. The minimum entry cost for public subscription typically ranges from HK3,000 to HK1, with the exact amount varying depending on the company going public. This variation is influenced by factors such as the offering price per share, the number of shares available for public subscription, and the company's size and industry. For example, a large-cap technology company with a higher share price may have a higher minimum entry cost compared to a small-cap manufacturing firm. This initial outlay covers the cost of the shares applied for, along with any associated fees charged by the brokerage. One notable feature of public subscription is the option to use margin financing, commonly known as 孖展融资 (margin financing) in Hong Kong, provided by brokerage firms. Margin financing allows investors to leverage their existing capital to apply for a larger number of shares than they could with their own funds alone. For instance, if an investor has HK1 and the brokerage offers a margin ratio of 1:9, they can apply for shares worth up to HK50,000, HK1 of their own money plus HK45,000 borrowed from the brokerage. However, it is essential to be aware of the interest costs associated with margin financing. These interest rates can vary between brokerages and are typically calculated based on the amount borrowed and the duration of the loan, which usually lasts from the subscription period until the shares are allocated or the funds are returned if the application is unsuccessful. In a scenario where the IPO is oversubscribed and the investor is only allocated a small number of shares, the interest costs could eat into any potential profits, or even result in a loss if the share price does not perform as expected. Oversubscription is a common occurrence in popular IPOs. And when this happens, a clawback mechanism is triggered. This mechanism adjusts the allocation of shares between institutional and retail investors. Initially, a certain percentage of the shares is set aside for institutional investors and the rest for retail investors. If the retail subscription is significantly oversubscribed, often by a specified multiple, such as 15 times or more, some shares from the institutional tranche are clawed back to the retail tranche, increasing the retail allocation ratio. For example, suppose a company initially allocates 10% of shares to retail investors and 90% to institutions. If the retail oversubscription reaches 50 times, the clawback mechanism might increase the retail allocation to 30%, with the institutional allocation dropping to 70%. This gives retail investors a higher chance of receiving shares. But it also means that the number of shares each retail investor gets may still be small if the oversubscription is extreme. It is important to note that the allocation process in public subscription is often done through a lottery system when oversubscription occurs. This means that even if an investor applies for a large number of shares, there is no guarantee of receiving the full amount requested. The odds of getting an allocation depend on the level of oversubscription. For highly sought-after IPOs, the oversubscription rate can reach hundreds of times, resulting in very low allocation rates, sometimes as low as 1% or less.